If you're flipping houses, you already know how to find deals, manage renovations, and make a profit. But here's the truth. Flipping houses is a job. It's not wealth building. Every time you sell a house, you got to start at ground zero again and get another one to get another check. I know this because even though I actually started investing in multifamily properties before I started flipping houses, I used to flip houses so I could buy more apartment buildings. I spent 5 years flipping houses, grinding it out, deal after deal, always chasing my next check so I could buy another apartment building. It was kind of like an addiction. I used to do a little, but a little wouldn't do it, so the little got more and more. And here's the thing. I got used to apartment buildings paying me every month, month in and month out. Checks that were being delivered to my mailbox, and all I had to do to get them was walk out in my slippers and coffee and collect them each day. So when I started flipping houses, I quickly got tired of chasing checks. But I did what I had to do so I could do what I wanted to do. And in this video, I'm going to walk you through exactly how to go through the transition of flipping houses to owning multifamily properties. I'll break down the biggest mindset shifts, the financial differences, and the step-by-step process that you can use so that you can start building long-term wealth today. And if you're tired of the flipping treadmill and you're ready to scale your real estate game, keep watching, because this is the video you wish you had seen years ago. Okay, so let's go right to step one on how to shift from flipping houses to multifamily wealth. So the first step is shifting your mindset, all right? So right now, I know what you're thinking because I used to be a flipper, all right? Single family flips. You buy low, you renovate, and you sell for a profit. Hopefully. In most cases, yes, you get those one or two deals, it's like, holy crap, there's a surprise on that one. But then you rinse, repeat. Every time you sell a property, you get a check. It's a beautiful thing. But then you have to buy another property. You have to find it. You have to outlay that cash. You got to manage the construction. And then you get another check. But here with multifamily properties, okay, you're buying an asset that generates income indefinitely and it creates wealth. You actually get paid 3 times with multifamily. You get paid at the closing. It's kind of like wholesaling, but you don't have to give up the deal. Okay, it's called an acquisition fee. And then after that, the very next month, you start getting cash flow coming in when you buy properly. Okay, we call those momentum plays, properties that cash flow at closing. And after that, you have wealth creation. And how does that come in? Well, through time, the value of real estate generally goes up. And when you buy, like we teach you how to buy with value adds in emerging markets or knowing what cycle you're in, then you have a higher probability of your property going up. Step 2 is to educate yourself. Because when you're investing in multifamily properties, there are a few things that you need to know that you may not know now. So let's go through those step by step. The first being the way we calculate the value of a multifamily property differs from a single family property. With a single family property, you do the comparable method. You compare like-kind properties within a mile of each other, same number of bedrooms, same number of square feet, and then you determine price based on what's sold in the last 6 months. But with a multifamily property, it's based on numbers. It's based on the NOI, which is the net operating income. So basically what you do is you take the income, you subtract the expenses, okay, and that gives you your net operating income. And that net operating income is actually a multiple. We will use the capitalization rate, which I'll explain in a little bit. We will use the capitalization rate to determine the price. Now here's the thing I want you to take away from this. You increase that net operating income, you increase that cash flow, and you've increased the price of the property. That's called forced appreciation. We'll talk about that a little bit more a little bit later. Secondly, the cap rate and the property values, all right? This is what I was just alluding to. So with that capitalization rate, when we divide a capitalization rate by the net operating income, that gives us the value of the property. Typically, the capitalization rates are anywhere from 4 to could be a 14, all right? The thing you want to note is that the higher the capitalization rate, the less expensive the property, the cheaper you're getting the property. In most cases, there's a lot of different variables that go into that. But if it's a high capitalization rate, it's around a 14, it's either really inexpensive or it's in a really bad area. If it's a lower capitalization rate, it's usually an expensive property and it could be in a very good area. So somewhere in between there. And that helps determine the property values. So next is financing. The way you finance a multifamily property is not the way you finance a single family property. Single family properties, you might go to your local bank and get a loan, construction loan perhaps, or you might go to a hard money lender because you're only going to hold that property for a short period of time and flip it over. But with a multifamily property, you're going to use a commercial mortgage to get it. And the best part about commercial mortgages are is that they don't necessarily look at you and your track record and your income, all right? They look at the property and the property's track record. So if that property's cash flowing properly, and they'll take 75% of that net operating income and they'll use it to qualify the property. If the property qualifies, there's a very good chance that you're going to get a loan for that deal just because the property qualifies with the numbers. Also, instead of going to hard money lenders, you actually do syndications. These are people that are very interested in investing in multifamily properties that have a lot of what we call dry powder, all right, money on the sidelines that they're looking to deploy somewhere. Usually these are high net worth individuals or other business owners, and they know real estate is the place they like to be, except they're very busy doing other things. So they're looking for people like you that they can invest in so that you can buy bigger deals, create more cash flow, create more wealth for you and them. That's the beautiful thing about multifamily. So step 3, you want to start networking, okay? You want to start getting into multifamily networks. And then getting into the networks, you want to join different communities. There's a ton of communities out there on Meetup, on Facebook with multifamily right now. You can join our community, rementor.com. You can see us on Facebook as well. But you want to start joining communities. You want to start talking to people. You want to start getting into the same mindset that everybody else is that is buying and selling and holding multifamily properties. You want to attend conferences. There's a lot of different conferences every year. You might go to conferences to meet brokers. You might go to conferences to get private money. You might go to conferences to learn. But start going to multifamily conferences to increase your knowledge base, okay? So that you know what it is. The more information you get, the more you learn, the more you earn. Simple as that. The other thing is you want to start creating relationships. All right, you want to start creating relationships with brokers because brokers are people that will send you deals on a regular basis, just with single-family properties, okay? You're getting good with brokers that are REO brokers, and they've got a source of deals coming on a regular basis. Get those deals, all right? With multifamily properties, the brokers basically, they got pocket listings, same as single-family, but you want to be at the top of their list so that when they have deals coming in, they're asking you to see them first. So you want to create those relationships. This is a relationship business, just like any business, but especially multifamily, because you're in relationships with your brokers, you're in relationships with your property managers, you're in relationships with your bankers, you're in relationships with your investors. It's all about the relationship. Anytime a mentorship student comes to me and says, Dave, I'm really struggling in my business and I don't know why, the first thing I'll say is, well, tell me about the last conversation you had with your best broker, the one that you consider the one most likely to give you your next deal. And if that conversation isn't about or is about real estate and not about something else that they may have in common, that's not really a relationship, because relationships deal with commonality, and you focus on the thing that you have in common with the other person outside of real estate. And when you do that, that relationship gets stronger. People do business with people that are like them, and when you're like the person, they also trust you. And that's how you start getting deals in the multifamily space. So relationships, relationships, relationships. I like to say, and I learned this in my first market, which was Brockton, Massachusetts, way back in 1996. I've been doing this business for a long time. But I realized that I got one REO broker at that time that had the Freddie Mac and Fannie Mae accounts, all right? So when I started closing on the deals, and those were smaller deals, those were 3 to 6 unit properties back then. When I started closing, they started giving me more deals. And when they started giving me more deals, I started talking to the other REO brokers that also had the Freddie Mac, Fannie Mae account, because there's always, at that time, there was always 3 or 4 in every city. So I talked to them, and I told them that I was closing, and I told them what deals I was closing, and whenever they call me, I'd go right out to the property, I'd take a look, and I would give them an offer right away so they could get it right back to Freddie Mac or Fannie Mae, and they looked good. So I did the work for them to help them look good with the people that they were doing businesses with as well. So one broker will make you rich because they'll give you pocket listings, and you will make a lot of money from that one broker, that one relationship. If you have relationships with 2 brokers, okay, they're going to make you very wealthy. And if you have relationships with 3 brokers in the same market, okay, they're going to retire your next generation. And I realized that's what happened in Brockton, Massachusetts way back then. And in every market, because we go around the country and we invest in emerging markets. As a matter of fact, we've invested in 27 different cities around the country in the last 20 plus years. But our goal is always to get 1, 2, and if we can get 3 brokers in a market feeding us pocket listings, that is nirvana. 1 broker in a market feeding you pocket listings is great because you do really, really well with them. So network, network, network. Number 4, start where you're comfortable. You know, when we first started teaching people how to invest in multifamily properties way back in 2002, all right, I used to tell people, you know, do 100-unit deals, because 100-unit deals, you're going to make a lot more money. You know, the average 100-unit deal, you're going to get $50,000 at the closing on that deal. No, I'm sorry. There's an acquisition fee. If you get 5% of the purchase price on an acquisition fee, and the purchase price was $4 million, that's $200,000 that goes into your pocket at the closing of that deal. Okay, at the closing of that deal, and the investors pay you that money. All right, it's industry standard in multifamily investing that the investors, and they know it, that the investors pay you that money at closing, because you put the deal together and you put the investors together and the deal closes, and you take no money out of your pocket. So then, you know, the average, so that's a 100-unit property, average price, say $4 million, all right? In 3 years' time, that's the average hold, unless you're in a really good market and you're going to hold it 5 or 7, maybe even 10 years, or maybe you'll have what's called a legacy property, and you'll hold it for a really long time. You give it to your next generation, all right? But in this hold period, let's say it's a 3-year hold, your average return is about a 40% increase on the property, which is only 13-point-something% per year, okay, when you buy properly, when you buy based on actual numbers. All right, so it's a $4 million property on that deal. So you're going to get $1.6 million at the closing. You're going to split that with your investors, but you're going to get a share of that. So in 3 years' time, because you bought properly, 40% of $4 million, or I should say 1.4, 140% of $4 million is 1.6. Okay, so when you're doing bigger deals, the money comes in faster. And I started teaching that at the very beginning. And then people weren't as successful as I thought they were going to be. So I started calling up my clients and saying, hey, you know, how come some people went out and killed it, but others, they're like, oh yeah, you know, I'm waiting for that 100-unit deal, and you know, haven't quite found one yet, or I found one of it, but it didn't have the right thing, and blah, blah, blah. The reality is a lot of people weren't comfortable doing that size deal when they first get out of the gate, but because we had taught that, they felt that's what they needed to do. So subconsciously, they weren't ready. There was a lot of fear involved, and they pulled back, and they didn't go forward. So then I realized that most people were like me when I first started. I had no experience. I was very afraid. I only did 3 to 6 unit properties for the first, about 3.5 years of buying, all right? And I only went into the larger 40 to 80 to 100 to 200 unit properties because I had to. I learned about emerging markets. I had a lot of money in 1031 exchanges, and I couldn't buy anything smaller than a 40 unit property with the amount of equity that I had in the deals when I went into my first emerging market. And that was scary for me as well. And I realized that people had to go through the same mindset shifts that I went through. You know, some of them did. You know, some of them didn't. Some of them were like, 100 units, I'm ready. You know, successful entrepreneurs, you know, high net worth individuals, people that were just ready to go. They were ready to go. And they did it. But for other people, you know, they weren't comfortable, you know, with the larger deals. So what I started teaching after that, it took me about a couple of years to figure this out. I started teaching, you know, the bigger deals will make you more money faster, but start where you're comfortable. Because if you never do that first deal, you never get started, you never get all the blessings of investing in multifamily properties. So after I started doing that, our success rate soared, okay? And our average journey went from first deal, 3 to 10 units, because you never do that first deal, nothing happens, okay? First deal is always your hardest deal. All right, so you just want to get it done, get it under your belt, your whole mindset shifts, you're a closer now, and you move forward. So with a 3 to 10 unit, and then after that, a 20 to 70 unit, because each time you step up, there's going to be a little anxiety going into bigger properties, and then you do a 100-plus unit deal. Doesn't mean you need to start at 3 to 10. You can start at a 20 to 70, okay? Or wherever you're comfortable. The most important thing is you start where you're comfortable, and then you move forward from there. And that's how you become successful investing in multifamily properties, and probably anything in life as well. Little steps get you the big rewards. All right, so step number 5 is leveraging partnerships, all right? In multifamily properties, you could certainly do this on your own. All right, before I used other people's money, I had been buying properties for almost 3 years. I was flipping single-family houses. I was using hard money. I was using credit cards to get my deals. I just wasn't using other people's money. And then I did the shift over to other people's money, and my deal size went from 40 units to 80 units to 300 units, and then 400 units. And then the average deal now is anywhere between 150 to 250 units, okay? And the investors are so happy to be investing with us because of the fact that they get returns on a regular basis, and they're passive investors. They get mailbox money as well. People love to be passive, especially when they're busy doing other things. Again, like high net worth individuals, entrepreneurs, There's a list of people out there that have dry powder that would like to get bigger returns than what they're getting on their 401ks, CDs, and all of that. So other people that you may look for is accredited investors. Accredited investor is somebody that earns over $200,000 per year. They have a net worth of $1 million per year, but they've got a financial mindset, and that's what you're looking for. The worst thing you can do is put a whole bunch of people in your deals for small amounts of money, for like $10,000, $20,000 each, that are sophisticated investors, which mean they don't earn over $200,000 a year or have a substantial net worth. And those people, I'm going to be straight and honest with you, those people are the biggest pain in the ass in any deal. So anytime you're going after doing a raise, what it's called, partnerships, you want to have the minimum amount of money coming in, at least $50,000, if not $100,000, and that will weed out a lot of the investors that are the pain in the asses. And also make sure they're accredited. All right, sophisticated doesn't count. Man on the street doesn't count. You want to focus on accredited investors. Most people, when they're starting out, they'll do sophisticated. Okay, that's just because their pool of resources on people that they can get money from isn't expansive yet. But as they build, they start putting less and less sophisticated investors in until one day you take no sophisticated investors. Because the more sophisticated investors or man on the street investors you have in your deals, the riskier that deal is going to be for you as the general partner in that deal. So you're going to be doing two types of partnerships, either a joint venture partnership, or syndication. Okay, the basic difference is a joint venture partnership has a lot less people, anywhere from say 5 to 7. All right, and everybody participates in management decisions. On a syndication, that type of a partnership, you have general partners, which would be you, okay, and the limited partners, which would be the passive investors. You make all of the decisions in the deals. The passive investors collect the checks, basically. So let's talk about some key differences between multifamily investing and single-family investing. Okay, we talked about the fact that the value of a multifamily property is based on the income method, not the comparable method, all right? And what this means is that you control the income of the property, all right? You can, what we call, force the appreciation. You can create additional income by increasing the rents, buying properties with value adds. That's what we call these things. You buy a property with a value add, all right? And value adds are properties that have lower than market rents, properties that have lower than market occupancy, properties that have higher expenses than normal, all right? And what you do is you take these properties and you hand it to the management company. The management company raises the rents. The management company raises the occupancy. The management company lowers the expenses. And by doing that, you increase the cash flow of the property. And then at the end of the year, your cash flow is that much higher, all right? And you divide it by the capitalization rate, and that property is worth that much more for you. So with single-family properties, you're really dependent upon the market, okay, and the appreciation in the marketplace and how well you bought it when you first bought it, okay? With multifamily properties, you really control the destiny of the cash flow and the value of that property. So, but there's one golden rule with multifamily investing, and that is when you're buying your property, you always buy the property based on actual numbers. You buy the property based on the actual numbers, okay? The seller wants to sell you that property based on the pro forma numbers, what the numbers could have been had he fixed the rents, had he fixed the occupancy, had he fixed the expenses, right? But you never buy a business based on what it can do. You buy a business based on what it's doing. And that's the exact same way the bank is going to evaluate the property as well. So if you ever get a multifamily pro forma, you know, the numbers that you're going to analyze to buy a property, and it says pro forma instead of actual, you cross out that word pro forma and you put the word pretend. Because basically that's what they're doing. They're pretending what the numbers could be, all right? And now when you buy based on conservative formulas, okay, based on the actual numbers, that property still cash flows at closing, all right? And then you buy with value adds. So you buy and the more value adds you have, the better. So it's cash flowing based on the actual numbers, and then you're able to raise the rents, and then you're able to raise the occupancy, and then you're lowering the expenses so that cash flow is even higher. So now you get all of the rewards that the owner was trying to pull out for not doing a good job and getting the management done on the property the way they were supposed to, okay? So always remember that. All right, let's talk about another key difference. Management becomes a little bit more complex, all right? So if you get single family properties, and you're holding them long term, you are probably managing those properties yourself, okay? Because it's really difficult to get a good single family property manager. I know certainly from my experience in that when I was doing it. 2 family, 3 family, you could be managing those yourself as well. But with multifamily properties, you do not manage yourself. You hire property management companies, okay? Your role is the asset manager. They deal with the tenants. They collect the rents, they handle the phone calls, they deal with the maintenance people that swing the hammers, that take out the trash, okay? Your role is to go out and get more deals and give more deals to the property management company so they can manage it and send you checks at the end of each month. So you are an asset manager. You should be getting one report each week. It's called the Monday morning report. It has all the key indicators on there. And then if something is an outlier, okay, something isn't right, that's when you call the management company and say, hey, what's up with the maintenance? It looks like that, the maintenance is at 92% and it should be 95% or higher. What's up with the maintenance on the property? What's getting left out? And the reason that's a concern is because the number one reason that somebody will leave your property is because of lack of response to maintenance requests. Write that down. It's really important. It's not because you raised the rent. It's because of the lack of response to maintenance requests. Okay. So the good news is you're not managing any tenants. All right. We like to say this. I used to teach the Multifamily Millions boot camp for 12 years until I started having kids. And I used to tell people from the front of the room, we have 300 or 400 people in that audience, and I'd say, listen, if I find out that you are managing your own properties, I will hunt you down and shoot you. I will put you out of your own misery, because that's what it is. Being a manager for multifamily properties is misery. Okay, some people absolutely love it, and those are the ones that you're going to hand your properties to so they can manage it for you. But in reality, it's not any fun, all right? And it stops you from your primary goal, which is wealth creation and getting more deals into your portfolio. So every time you're handling a call from a tenant, anytime you're going over and fixing something, that's taking away from building wealth for you and your family. So don't do it. All right, so the other thing you're going to do is you'll be able to optimize expenses by doing bulk purchases because, with a multifamily, you've got all the units in one particular area. You can be efficient with your staffing, and you can create better leases that will make everything more efficient. So let's talk about different economies of scale. In a single family, if you lose a tenant, you've lost the rent, 100% of it. Until you get another tenant, you've got no money coming in. So how are you going to pay the mortgage? Well, you got to take it out of Hip National Bank, right? You got to take it out of your own pocket. How do you pay the taxes? Out of your own pocket. How do you pay the insurance? Out of your own pocket. Right? That's not what we like. With a multifamily property, if you lose a tenant, depending on how many units you have, regardless, you still have rent coming in, okay? The more units you have under one roof, the less of an impact that losing a tenant or a couple of tenants is going to have. So one of my mentors told me a long time ago, is like, Dave, the more units you have under one roof, the better you are, the more efficient you can run that property. And I remember one time, her name was Dana. And I remember one time I said, Dana, I get this opportunity. It's in Jackson, Mississippi, and I'm looking at buying a portfolio of 5 different properties there. And she said, Dave, don't do it. And I said, well, why not? Well, first of all, she said, are they contiguous? Meaning, are they side by side or are they in the same area? And I said, no, they're all around Jackson, but it's the same owner. And she said, yeah. She said, don't do it. She said, you won't get the economies of scale as if you had them in one complex. So the goal is always to get as many units as you can under one roof because the economies of scale are going to allow you to run that property more efficiently and you're going to make more money. So always remember that advice. That has served me well all through the years. All right, now let's talk about some of the benefits of multifamily investing, which is, number one, you buy once and you get paid. First, you get paid at the closing of the deal, again, which would be a flipping fee. If you were going to flip a single-family property, okay, but you don't have to flip it. You can get the acquisition fee, and then you can get paid month after month, and then you get a big payday somewhere later on down the line. You could refinance that property and hold it even longer than that. But you buy it once, and it continuously gives you revenues year after year after year, month after month, year after year. It's a real business. When the rents rise, you get a raise, and that's a beautiful thing. So you can, when a property appreciates, when you buy with low rents or just the market appreciates itself, you've got a raise. You get more cash flow coming in on a regular basis. And the more units you have in that property, the bigger the raise. With a single family property, yeah, you can raise those rents, but you get one property that raises maybe $100, $200. 100-unit property, you get $100, $200 per unit. It's a lot of money. When the occupancy rises, you get a raise. When the expenses decrease, you get a raise. So I think you're getting the feeling that, with multifamily properties, there's a lot of things that you can do to bring more money into your house, your household, and it's a beautiful thing. Scalability. Look at this neighborhood, all right? Imagine that it's a whole town or a whole city, all right? Let's say you have 16 properties here, all right? When you have 16 properties all throughout a city or town, you've got 16 roofs that need to be replaced somewhere in the future. Maybe the near future, maybe farther off in the future, but somewhere it's going to happen. If you've got 16 properties all spread out throughout a city or town, you've got maintenance requests that our maintenance guys are going to have to go all these different places. There's going to be a lot of travel time, which is very inefficient. Then also you've got a landscaping company that will go from property to property to property to mow the lawns at, who knows, $50, $100, $150 a pop. With a single family property, you have one roof, you have one lawn, and you have all of your tenants centrally located. So you can scale these properties. Not only does the economy of scale favor multifamily properties, but it also allows you to scale your portfolio a lot easier and create a lot more wealth with multifamily properties. There's also tax benefits that you don't get with single-family properties. Number one, we can do what's called cost segregation on a property, which is we can depreciate different items faster than with single-family properties, because you're not going to typically a flip. You don't do cost segregation. A cost segregation works when you're holding a property for X amount of years or longer. And you can do depreciation on your properties each year, which lowers your taxes from other income that you're getting in other places, which is a beautiful, beautiful thing. With a single-family property, when you're flipping it, what do you get? You get a short-term capital gains, okay? And that's, unless you do, yeah, potentially you could do a 1031 exchange into another property, but you can only get so high with single-family properties, when you're doing these exchanges. With a multifamily property, you do a 1031 exchange on a 3-unit property that brings you to a 10-unit property, that brings you to a 50-unit property, that brings you to a 100-plus unit property, and you've not paid taxes on any of them. You've deferred the taxes using a 1031 exchange. That's another strategy that you can use for wealth creation with multifamily properties that you can't really use for single-family properties. Also, financing. With multifamily properties, $1 million or more, typically they're non-recourse loans, all right? So if something happens to that property, they're not coming after you. They're just going to take it back, and that's a beautiful thing. So the risk of something happening, you're always investing in real estate, any type of real estate, is risky, right? We're always trying to mitigate our risk and lessen our risk wherever we can, and this is one of the ways we can, by getting a non-recourse loan. So how is your life going to change when you transition from a single-family flipper over to a multifamily investor? Number one, you don't have to chase deals constantly, all right? When you buy a deal, that check's going to come in month and month out. You buy another deal, that just adds on to what's coming in and month out. So it's not a constant chase. It's a buy and hold strategy. Also, you're going to have more freedom. You're going to have more freedom. You're going to have more time. So you can decide what you want to do with that freedom or time. Do you want to travel? Do you want to spend time with your family? Do you want to go after other ventures? Bottom line is you're going to have more freedom. You're going to have more time to do more things. Okay, so you're not going to be chasing contractors. You're not going to be managing construction deals. You're going to be focused on getting more deals. You're going to be focused on cash flow, and you're going to be focused on creating wealth. And then there's going to come a time, okay, and this should be at the start of your multifamily investing. You got to decide what your number is. All right, your number is, what is that number, your walkaway number, the FU number, okay? The number where you're done. You don't have to buy any more properties, knowing that you've hit your number, you've got your cash flow coming in, it's going to come in, month out. You've got the equity in your properties that's going to increase year after year after year. Your tenants are going to be paying down your mortgage year after year after year to help that equity increase. Eventually, if you hold it long enough, they'll pay off the building, all right? So all of this is going to equal a number. And what's your number? Is your number $30,000 a month with $5 million in equity? Is it $50,000 a month with $10 million in equity? Is it $100,000 a month in cash flow with $20 million in equity? Whatever your number is, we can break that down for you, and we can tell you how many units that is. And when you hit that number, you're done. You are done. And you enjoy the rest of your life. We like to say in multifamily investing is if you will do for 3 to 5 years what most people won't do, you will be able to do for the rest of your life what most people can't. So listen, if you like this information, I have one final thought, but if you like this information, if you could like and subscribe to this channel, and you'll be sure to be notified of additional information that we're going to be sending out, and we're going to start sending out on a regular basis. Appreciate that. So the final thought is this. With multifamily properties, you focus on building long-term wealth. With single-family properties, you're basically trading time for money. Yes, it's a well-paying job, but in the end, it's a job.